Did you know ESG efforts started in the 1960s? The traceback of ESG, environmental, social, and governance, lies in its evolution as a framework for evaluating the sustainability and ethical impact of businesses. The effort started with the socially responsible investing (SRI) movement, which began in the 1960s. Investors started excluding stocks of companies involved in unethical practices, for example, tobacco, apartheid in South Africa. Key example: activists called for divestment from companies operating in apartheid-era South Africa. Then, another landmark effort was environmental awareness carried out by different heroes. Events like the publication of Silent Spring by Rachel Carson, 1962, an awesome book you won't regret reading, and the establishment of Earth Day, 1970, increased focus on environmental issues. The traceback of ESG reveals its evolution from a niche ethical investing concept to a global framework central to corporate strategy and investment decisions. ESG continues to adapt to new challenges, such as climate change, technological advancements, and shifting societal expectations, solidifying its role in shaping sustainable futures. Environmental, social, and governance, ESG, has evolved over decades, reflecting humanity's growing awareness of the interplay between business, society, and the planet. Here's an in-depth look at its origins and milestones. 1. Early beginnings: ethical investing and social responsibility, 1960s, 1980s. In this era, investors were encouraged to consider ethical and social criteria when choosing investments, excluding industries associated with harm, such as tobacco or companies complicit in apartheid. A key example here is that activists called for divestment from companies operating in apartheid-era South Africa, one of the most significant SRI milestones. The global divestment movement to combat South African apartheid was widespread and often met with political and economic backlash from both government and university officials across the U.S. and abroad. While divestment itself consisted of corporations, states, municipalities, and universities working to cut ties with the South African government and economy, it later became apparent that these sectors were deeply intertwined and that many of the top officials within these sectors were opposed to such drastic measures of political protest and economic intervention. In the UK, the anti-apartheid movement, AAM, catalyzed global action, calling for international sanctions and divestment at every level from governments to universities and private corporations. In the U.S., activists lobbied for divestment from pension funds and endowments, leading to political and economic backlash, but ultimately contributing to the weakening of South Africa's apartheid system. In short, the apartheid divestment campaign highlighted the power of financial decisions to drive social and political change, setting the stage for the emerging principles of ESG we are talking about now. What began as a niche investment strategy has grown exponentially. The global SRI market across equities, fixed income, and other asset classes is now worth nearly $23 trillion, with Europe and the U.S. managing the majority of these assets. Another effort was the launch of the iShares MSCI USA ESG Select ETF in 2005. The effort seeks to track the investment results of an index composed of U.S. companies that have positive environmental, social, and governance characteristics, as identified by the index provider. As part of its objective, this fund seeks to track an index that applies the businesses like alcohol, civilian firearms, controversial weapons, conventional weapons, fossil fuel extraction, gambling, nuclear power, nuclear weapons, thermal coal power, and tobacco. The business involvement screens are based on revenue or percentage of revenue thresholds for certain categories and categorical exclusions for others. Today, more than $11 billion in assets are managed across 120 ESG-focused funds globally. Should we expect the growth of ESG in the next 10 years to hit $37 billion? Stay tuned for part 2 of this era.